Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of business for you. Today we're diving deep into GSR Acquisition Corp's latest quarterly report, and let's just say things are getting interesting and a little bit complicated. So what's the big story here? It seems GSR Acquisition Corp is a special kind of company, a blank check company, meaning it was formed to buy another company. And in this report, we get a look at their financial health as they're actively looking for that big acquisition, especially after a recent business combination agreement they signed. This document is their quarterly report, basically a checkup on their financial health for the period ending June 30th, 2025. This is the company we're looking at, GSR Acquisition Corp. They're incorporated in the Cayman Islands, but their principal executive offices are here in Austin, Texas. Let's talk about their shares. They have Class A ordinary shares and Class B ordinary shares. It's important to note that the Class A shares, the ones most public investors would own, are subject to redemption, meaning shareholders can get their money back under certain circumstances. As for their reporting duties, they've filed all the required reports in the last year, which is good. They also identify themselves as a smaller reporting company and an emerging growth company, which means they have some flexibilities in how they report things, but it also means they're still growing and finding their feet. Now let's get to the heart of it, the financial tables. This is where we see the numbers that really tell us what's going on. First, we have the balance sheets, which is like a snapshot of what the company owns and owes at a specific point in time. Here's a massive number, over $236 million in cash and investments held in a trust account on June 30th, 2025. This is the money they raised from investors meant for buying another company. It's a huge chunk of their assets. Their total assets are just over $237 million. Most of that, as we saw, is cash sitting in that trust account. On the other side, their total liabilities are around $10 million. That's a lot lower than their assets, which makes sense for a company in this stage. Now, here's something crucial. They have an accumulated deficit of over $9 million. This means that so far, the company has spent more money than it has earned. This is pretty normal for a startup or a blank check company before it makes its big acquisition. Next up are the statements of operations. This tells us how much money they made and spent over a period, essentially showing if they're profitable. For the 3 months ending June 30th, 2025, they reported a net income of around $1.9 million. That sounds good, right? But look closely. This income isn't from running a business, but from interest and dividends earned on the money held in their trust account. So it's more like investment income than business profit. They also have general and administrative expenses, which are the cost of running the company itself, like salaries and office expenses. For the 3 months, these were about $535,000. And when we look at the earnings per share for the non-redeemable shares, it's about 7 cents. Now let's look at the statements of changes in stockholders' equity. This shows how the owner's stake in the company has changed. At the end of 2024, their total shareholders' deficit was about negative $7.3 million. By June 30th, 2025, this deficit grew to about negative $9.1 million. This confirms that the company is spending money as it searches for a business to acquire. The increase in the deficit is mainly due to the costs associated with managing the trust account and general operations. The statements of cash flows are super important because they track the actual cash coming in and going out. Cash is king after all. For the first 6 months of 2025, they used over $924,000 in cash for their operating activities. Again, this is expected for a company like this before a merger. Their cash on hand at the end of the period outside of the trust account is about $862,000. That's the money they have to actually run things day to day. And here we see another item, a significant adjustment related to the measurement of redeemable shares. This is an accounting term that basically means the value of shares that can be redeemed by shareholders is being adjusted, and this adjustment is quite large, showing how complex these redeemable shares can be. Digging into the notes, we learn more about their setup. They were incorporated in May 2023, and all their activity so far has been about forming the company and its initial public offering, the IPO. A major event happened on April 21st, 2025. They're signing a business combination agreement with an Italian company called Terra Innovatum. This is the potential acquisition they're working on. Their IPO, where they sell shares to the public to raise money, had its registration statement declared effective in November 2024. They raised a massive $230 million from the IPO with another $4.2 million from a private placement. This money, as we saw, is mostly held in that trust account. There are rules they have to follow. For instance, the company they acquire needs to be worth at least 80% of the assets in their trust account. That's a big hurdle. Now, an important section here is about going concern consideration. This is where they discuss if the company can stay in business for the next year. They explicitly state that there's doubt about their ability to continue as a going concern if they don't complete a business combination. This is a standard disclosure for companies like this, but it highlights the urgency of finding a deal. The report also details how they calculate earnings per share, separating it for redeemable and non-redeemable shares. This really shows the complexity of accounting for these different types of shares. This part details the actual IPO. They sold 23 million units, each unit containing one Class A share and a portion of a right. Pretty standard stuff for these kinds of companies. Related party transactions are always worth a look. Here we see the sponsor, likely the investment firm that started this company, gets paid for office space and administrative services. In the first 6 months of 2025, that was over $333,000. They also discuss a promissory note and potential working capital loans from related parties. This section breaks down the different classes of shares, like the Class A and Class B shares we mentioned earlier. Interestingly, Class B shareholders have the power to appoint all the directors before a business combination. They also state they've reviewed events after the balance sheet date and found no material events requiring adjustment or disclosure. This means nothing huge changed right after June 30th. Now, the management's discussion and analysis, or MD&A. This is management's own explanation of their financial situation. They include a standard cautionary note regarding forward-looking statements. This basically means that any predictions they make about the future might not come true because of various risks and uncertainties. It's a legal protection. They've laid out their plan for the next year using the cash outside the trust account for finding and evaluating businesses to buy. This includes due diligence, travel, and negotiations. They mention that if they can't find a business combination within a certain period, they might try to extend that time, but this requires shareholder approval. Overall assessment trues. So what's the big picture here for GSR3 Acquisition Corp? They're in the typical pre-acquisition phase for a SPAC, a special purpose acquisition company. They've successfully raised a lot of capital, but it's all sitting in a trust account, earning interest rather than being used to grow a business. Their financials show a company that is spending money on its operations and search for a merger, leading to a growing deficit, which is expected. The key number to watch is that $36 million in the trust account. Their future hinges entirely on successfully completing a business combination like the one they've agreed to with Terra Innovatum. The risks for companies like this are clear: failing to find a suitor company that is spending money on its operations and search for a merger, leading to a growing deficit, which is expected. The key number to watch is that $36 million in the trust account. Their future hinges entirely on successfully completing a business combination like the one they've agreed to with Terra Innovatum. The trust account, their future hinges entirely on successfully completing a business combination like the one they've agreed to. Alright, that's our deep dive into GSR3 Acquisition Corp's latest SEC filing. What do you think about their strategy and the numbers presented? Let me know in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe to Corporate Decoder for more insights into the world of business and finance. And don't forget to join our Discord community. The link is right there in the description. Thanks for watching, and we'll see you in the next one.